Reaching a $1,000 mark in monthly dividend income is an exciting milestone. Will it allow you to retire because funds are being deposited into your account for doing nothing? Probably not. But with the accelerating interest and compounding effect, you might get there sooner than you think. When your account reaches this size, you'll likely become more dedicated to growing that account to the point where you can live your dream lifestyle and retire. How much money do you need to invest to safely generate this much income? You can check how much money you need to make $1,000 per month in dividends by running some different scenarios. Stay until the end to learn how to choose the best option for you. Welcome to Cashflow Canvas, where we help people learn about money, personal finance, and investing. If you're interested in improving your financial future, be sure to watch this video. If this video proved helpful, please subscribe to the channel and hit the like button. Your first step to earning $1,000 per month is deciding on a desired dividend yield. This isn't supposed to be the highest yield you can possibly find, but the appropriate amount of growth income and stability to suit your situation. You might have heard people talk about receiving dividends from a stock that yields 2, 3, or 5%, when you could simply buy a stock yielding 12% and earn much more money. The truth is that buying something with an extremely high dividend yield can be risky, as the price could fall or the dividends could be cut. Risk is often the case with an individual stock or even a sector-specific fund. Reasonable dividend yields can start at 5% and rise to 5% over time, so aim for something in that range. The mistake investors frequently make is purchasing assets with a high yield. There are two scenarios in which this could be an issue. At first, a high yield may imply a company with limited growth prospects, in which case the market expects a larger yield. This is because there will be little in the way of stock appreciation. The same logic applies to an entire industry, as the market prices sectors are based on future growth risk and other criteria. One example is the tobacco corporation Altria. This stock has been rising and falling for years and is now priced the same as it was in 2014. To compensate for the somewhat flat stock price, the dividend yield is roughly 8%. Investors seeking an 8% dividend in exchange for little share price growth when looking at an entire sector such as oil and gas. The dividends are higher than others because some investors anticipate a decline in oil demand at some point in the future. The second high-yield situation is a little more concerning because the dividend isn't guaranteed. A hazardous dividend indicates that the company may lower or discontinue its payout in the future owing to poor financial performance. These are the types of companies to avoid, so do your homework. A cut dividend usually always results in a decline in stock price. However, investors may sell the shares ahead of time if a cut dividend is expected. This could be the case for an entire segment of the market with retail, for example. For someone who wants a hands-off approach, purchasing a dividend ETF like Schwab Stud, which is very popular and well-liked among dividend investors, can work nicely. This fund matches the return of the Dow Jones United States Dividend 100 Index, which includes companies such as Home Depot, Texas Instruments, and BlackRock. By investing in this, you would receive a stable 3% income with a decent degree of growth to ensure the value of your investment improves over time. To receive a 3% dividend yield, you would need to purchase around 4 shares. VUG is Vanguard's growth ETF, and it is ideal for investors who aren't bothered with dividends and simply want to earn higher overall returns. This fund tracks the Crest Major Cap Growth Index, which increases rapidly on average. This is due to the fact that the largest holdings are Apple, Microsoft, and Alphabet, all of which are major established corporations. The dividends they pay are minimal, with a yield of only 4%. This means you'd need nearly $2,750,000 just to earn $1,000 per month in dividends. While that may seem like a paltry amount of dividends for that much capital, consider that the growth alone outpaces what you'd get from dividends. With the dividend fund, you'd most likely obtain both dividends and growth. In other words, even with dividends reinvested, you'd be better off with a quality growth fund like this. Buying the market or a fund that tracks the S&P 500 index may provide the finest combination of growth and dividends. As a result, you get an average amount of income with a moderate rate of increase. This is one of the better solutions for someone who doesn't want to think about their investment plan too much and wants a relatively balanced portfolio. Purchasing a fund such as VU or the Vanguard S&P 500 ETF would provide exposure to a broad variety of firms you'd own. The dividend yield is average because you're buying the market at 1.31%. In order to bring in $1,000 per month, you'd need roughly $920,000 invested. Still a lot, but significantly less money is required than a more aggressive investment strategy. By selecting a sector-specific fund, you can obtain higher dividends and greater diversification than you would from a single stock. This would be a fund dedicated to a specific area, such as real estate, finance industries, utilities, and so on. By looking at numerous possibilities, you can find ones that offer bigger dividends than others if you do your research. If you're positive on one of those sectors, it could be a good time to buy, but there's generally a reason or several reasons why a sector has a high yield, and it's critical to understand why the dividends are higher and analyze the risk. In early 2020, the energy sector was trading at a huge discount relative to other sectors, presenting an opportunity for growth and dividends for those who understand its risks and potential reward. Purchasing is the riskiest and least predictable option. Individual dividend stocks may provide a larger yield and, in the case of Altria, may provide better growth. You simply need $150,000 to earn $1,000 each month in dividends. Keep in mind that the stock price's future is less predictable than buying something with more diversification, even if you buy Altria. Others went broke chasing a high yield, knowing the different options and their pros and cons. Which direction should you go? A strategy investors commonly use is focusing on growth early on in their investment career. This is the time when you're in your 20s, 30s, or even 40s. Your primary concern is achieving higher growth. Dividend income is irrelevant unless you plan on retiring early. Young investors who focus solely on growth will usually have better annual returns than someone who is only concerned with dividend income. Even slightly better annual returns can make a huge difference over time. If you plan on living on those payments as you age, you're less concerned with annual growth and more concerned with income safety and capital preservation. When approached cautiously, a dividend investment strategy is safer and more stable than a higher risk growth strategy. When you're many years away from drawing on your investments, the difference between growth and dividend investments is how long until you intend on retiring. Implementing a dividend investing plan could cost you hundreds of thousands of dollars in lost potential interest. While it may be appealing to younger investors to think of dividends as fully passive income, growing share prices are also appealing.